Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning and a warm welcome to Hong Kong's top-rated business and finance show. This is Peter Lewis with the original Money Talk. The podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. Here are the headlines for today, Friday the 21st of April. In a major speech yesterday setting out the Biden administration's economic policy towards China, US Treasury Secretary Janet Yellen called for a constructive and fair economic relationship between China and the US, but she warned any effort to decouple from China would be disastrous. She also announced the Biden administration was considering a program to restrict certain US outbound investment in specific sensitive technologies with significant national security implications. The People's Bank of China kept its loan prime rates for 1-year and 5-year loans unchanged on Thursday. The country's benchmark lending rates have remained on hold since August 2022. The 1-year rate, which affects new loans, was kept steady at 3.65%. The 5-year rate, which influences mortgages, was unchanged at 4.3%. Taiwan export orders plunged by the most since the global financial crisis last month. Orders for Taiwanese exports tumbled 25.7% year-on-year, accelerating from an 18.3% drop in February. It was the largest annual decline since January 2009 due to weaker demand for almost all product groups and ongoing slack consumer demand in Europe, the US and mainland China. Australia is planning the biggest shake-up of its central bank in decades following an independent review of the Reserve Bank of Australia. Changes to the RBA include the creation of an expert policy committee responsible for setting interest rates, mirroring the approach in Canada and the UK. RBA policymakers would now gather to set interest rates 8 times a year, compared with current 11 meetings. The move comes amid criticism from some lawmakers and economists that officials took too long to tighten policy in response to accelerating inflation. On today's programme, I'm joined by Francis Lun, the CEO of Securities, and Marc Franklin, Managing Director and Senior Portfolio Manager of Multi-Asset Solutions at Manulife Investment Management here in Hong Kong. With a view from Australia is Toby Lawson, Director at Statton Advice. And if you want to get in touch, please go to my website, which is peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks slipped Thursday in reaction to a mixed bag of corporate earnings and soft economic data in the form of rising jobless claims and a slumping Philly Fed manufacturing survey index. The S&P 500 dropped 0.6% to finish at 4,130. The S&P 500 has now gone 20 straight sessions without falling more than 1%. The Dow lost 110 points, that's 1/3%, to close at 33,787. The Nasdaq Composite slipped 0.8% to settle at 12,060. Tesla shares plunged almost 10%. After price cuts to its electric vehicles caused its gross profit margin to slip to its lowest level in 13 quarters. Chief Executive Elon Musk on Wednesday indicated that he's perfectly willing to sacrifice profits to boost demand and capture market share. Chinese markets were mixed. The Shanghai Composite was down 0.1% at 3,367. Hong Kong's Hang Seng Index ended the day 29 points or 0.1% higher at 20,397. Futures markets are pointing to a fall of 117 points or 0.6% for the Hang Seng at the open this morning. And elsewhere in the markets, Treasury yields fell on Thursday as investors assessed the interest rate outlook. This morning, Fed Fund futures markets are signalling an 84% chance of a 25 basis points rate hike in 2 weeks' time. The yield on the 10-year Treasury was down by 5 basis points to 3.54%. And soft economic data from the US sent oil prices to their lowest since the surprise OPEC price cut announcement. Brent crude oil tumbled 2.4% to $81.10 a barrel. And you can get all the latest market movements on my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk.
Peter Lewis's Money Talk.
And it's time to welcome our guests. We have with us Francis Lun, who is the CEO of GEO Securities. Morning, Francis.
Hi, good morning.
And also with us is Marc Franklin, Managing Director and Senior Portfolio Manager of Multi-Asset Solutions at Manulife Investment Management, right here in Hong Kong. Morning, Marc.
Good morning, Peter.
Now, in a major speech yesterday setting out the Biden administration's economic policy towards China, US Treasury Secretary Janet Yellen called for a constructive and fair economic relationship between China and the US, but she warned any effort to decouple from China would be disastrous. Ms. Yellen said both countries needed to be able to discuss difficult issues frankly. She said the US would continue to work with allies to resist Beijing's unfair economic policies. She said China's decision in recent years to pivot from market reforms to a more state-driven approach had undercut its neighbours and countries across the world, and she went on to maintain that the US was not trying to undermine China. Ms. Yellen also announced that the Biden administration was considering a program to restrict certain US outbound investment in specific sensitive technologies with significant national security implications, which are measures likely to further anger Beijing. So, Francis, do you see this as an olive branch at all to China in any way?
Yeah, ever since Blinken canceled his visit to China because of the balloon issue, China has rebuffed all attempts by the U.S. to restart diplomatic dialogue. In the meantime, China make a surprise diplomatic success in bringing Saudi Arabia and Iran together. And that really shocked the U.S. because the U.S. thought it was the arbiter in the Middle East. So in many areas, Chinese diplomacy is undercutting American influence. The U.S. never really worried about South Pacific, but now it has a lot of diplomatic activities in South Pacific and Southeast Asia and the Middle East. So, but at the same time, the U.S. fear China's economic might because maybe in 5 years' time, China will equal the U.S. in gross GDP. But that's why the U.S. is really keen on keeping its advantage, especially in semiconductor and high technology. That's why it's putting all these sanctions and blacklists on the semiconductor and chips technology, etc. So on the one hand, you have fear. On the other hand, the U.S. wants to make money because Apple and Tesla make 30% of the profit in China. They cannot afford to get it cut off. Boeing has already been cut off for 2 or 3 years now, so it's losing big money. So it's a mixed bag of this. That's why China want to restart diplomatic dialogue with China.
Marc, I'm sure the intentions here are good, aren't they? Ms. Yellen's sort of fairly diplomatic, and obviously she wants to get the relationship back on track. Do you think this will do that?
Short answer is no. I think that the tone of Yellen's speech is designed to try to cool the heat in the dynamic that we've seen over the last few months. But I spot somewhat of a divergence in approach and intention from Yellen versus other members of the Biden administration. I think that Yellen historically has had very, very strong relationships with the major Wall Street banks. And the banks are particularly nervous about the risk of, let's say, a forced decoupling rather than something that is incremental, given their determination and desire to benefit from the opening up of the Chinese capital markets. So her approach is with her, let's say, her lobbyists in mind. But ultimately, I don't think that the current Chinese leadership recognizes the concept of guardrails to the relationship. No matter what kind of spin Yellen puts on some of these measures, the Chinese leadership will still see these as restricting China's development and progress potential.
The problem is, Marc, isn't it that, on the one hand, you have Janet Yellen here saying she wants a normal economic relationship, and then the next day, the US goes and puts more export restrictions, that impact Chinese technology companies, or you have the US Trade Secretary, Gina Raimondo, who is definitely a China hawk, saying that, the US needs to take a tougher line.
Well, that's right. I mean, one of the things which has crept back into the narrative and the discourse in the last few days has been revisiting the trade deal that Trump's administration signed with China and the lack of fulfillment of some of those obligations from the Chinese side. And the Biden administration seems to be wanting to revisit that and use that as a backdrop for further restrictions. Again, you have to look back and say that was an unsuccessful initiative. And just effectively trying to repeat that same approach is unlikely to yield positive results again.
And there was a bit of a sting in the tail, wasn't there, in Janet Yellen's speech, because she announced that the US is going to restrict outbound investment now in specific sensitive technologies. So once again, it's giving with one hand, taking away with the other.
That's right. One of the concerns that the US has, but also other powers that are major high-end technology exporters, is that some of these technologies, particularly in the semiconductor space, are unfortunately finding their way into military capabilities or military usage, whereas they were initially designed for commercial civilian usage. And I think that's something which the US and the powers such as Japan and the Netherlands are quite concerned about. I think in addition to that as well, is maintaining or an attempt to maintain, it's not about parity of GDP, because on a purchasing power parity basis, many people would argue that China is already there. And on nominal basis, it's going to take many, many more years than 5 years to reach that point. It's actually more about leadership in key areas of technology development, whether that's cyberspace, security, AI, and the usage of semiconductors in those verticals. And that's what they're trying to focus on at the moment.
Francis, do you think the US can have it both ways? That's what they seem to want here, isn't it? They want on the one hand this normal economic relationship with China where they trade with each other, and as we know, trade was at a record high last year. But then at the same time, there's certain things they want to restrict, particularly in the technologies sector. Can they have both?
No, they cannot have their cake and eat it too. You either have your cake or you don't have a cake. So I think China, the US is trying to have it both ways. How can you put so much restrictions on the semiconductor exports, and especially putting pressure on Holland to stop ASML exporting the optical etching machine to China, because ASML almost has a monopoly on these machines. So these are all hostile acts, but the US sees it as the only way that it can maintain its technology edge over China, because in other manufacturing, China already matched the US. But one thing that the Biden administration can do is really cancel all those tariffs imposed by Donald Trump, because frankly, the trade war is not working in the U.S.'s favor. And American consumers are paying 20% or more for Chinese imports. I think this is not a constructive tariff. I think America can cut its inflation rate immediately by removing the tariff.
Marc, you probably remember back to the 2008 financial crisis. Hank Paulson, when he was the US Treasury Secretary then, he was really frequently coordinating, wasn't he, with his Chinese counterparts. There was a lot of interaction between the US and China at the time. I suppose it's hard to imagine that today, isn't it? Getting back to that sort of level of cooperation.
The world was a very different place then, and the point in China's evolution, both economically and politically, was different as well. But it does serve as a reminder the importance of coordination, particularly during crises, both economic and non-economic. Don't necessarily believe the media narrative that there is zero connectivity between the Biden administration and Xi's administration in China right now. There are lines of communication still, particularly in economics and finance. Indeed, Yellen met with Yi Gang, the governor of the PBOC, just a few days back. So a lot of the dynamics that we see and we hear in the speech they're given, we have to remember that many situations, they are geared towards a domestic audience and to serve a domestic narrative. And so the truth is somewhere closer to the middle rather than at one of the extremes.
I mean, there is a looming crisis, isn't there, which could affect US-China relations, and that's this debate over the debt ceiling. If America were to default, that would really badly undermine the dollar, wouldn't it, and also have a big impact on China?
It wouldn't necessarily undermine the dollar, because what else is also going on at this current moment is that we've seen a massive drawdown of the Treasury General account by Yellen as a means to actually support financial markets and to mitigate and sterilize effects of QT. That can't go on forever. And QT, the program that's been running in the background, will start to reassert itself. And that will actually draw US dollar liquidity out of the system. And so what you might actually see, even with the debt ceiling dynamics going on, is the potential for a tactical dollar appreciation. So it's not a given that the dollar would weaken. Neither is it a given that treasuries, particularly those that are seen as the most safe haven parts of the curve, would necessarily decline in value. They may also be seen as a source of dollars in a shrinking dollar liquidity situation.
Francis, can I ask you about the economic data that we had this week? I suppose the highlight was the economy grew at the fastest pace in a year. Retail sales rose more than 10%. But officials don't seem very happy about it, do they? The National Bureau of Statistics spokesman was saying the foundation for the economic rebound is not solid. We've got the National Reform and Development Commission saying they need to boost consumption. What is it that they're concerned about?
Well, I think what they're concerned about is really industrial production and industrial profit. I think on the one hand, you have a relaxation of COVID control, then the people are going out and spend. So you have a very strong rise in the consumer spending. But the other problem is that the export orders are not going up. The factories are not really running at full tilt. And if you look at the Taiwan trade figures, you find out that globally there is a slowdown in trade because the demand is quite weak. Europe is still hurt by inflation and the Ukraine war, and the U.S. is also hurt by inflation also. So all these things have a negative impact on the consumer demand in the U.S. and the EU, and this resulted in lower industrial production in China. So to have a robust recovery, I think you need global economies like the EU and the US to emerge out of this inflation-driven recession. What you have is my recession right now, mainly due to inflation.
But the data we saw today out of the US wasn't very encouraging, was it? It seems to suggest that maybe the US will slip into recession.
Yeah, definitely. I think that's what people fear. That's why the US market fell overnight. This will continue to haunt U.S. equities because the industrial giants are really not making that much money. They don't report stellar results.
Mark, when you look into this data, I mean, the headline numbers obviously quite good, but then when you start digging into it, you see things like business investment, for example, quite weak, which sort of suggests that businesses just don't seem to have that much confidence in the economy. What are your thoughts?
Some of the GDP data that came out of China for Q1 had a benefit from revisions to prior data. So we have to discount some of the superficial strength in certain numbers. That's the first thing to say. The second thing to say is that there is still excess capacity in many areas of the Chinese economy. When you combine that with also somewhat of a more uncertain outlook, that is why business investment, business spending is not recovering strongly. Where also Chinese consumers are re-engaging is travel outbound and spending on luxury consumer discretionary outside the borders of China. So that's why you're seeing very, very strong results from some of the luxury goods companies that are listed in Europe, whereas actually those consumers are not deploying that discretionary spending as much domestically. So China's reopening has been very, very helpful for the global economy from a very low base. But so far, the main beneficiaries are not necessarily the domestic Chinese economy, but certain parts of the European economy and the European stock market, ironically.
And why have we got this disconnect between government stimulus and sort of weak industrial production? Where's all this stimulus going? Because we're seeing an enormous amount, aren't we?
Well, in China, the stimulus is not really that big. I think in the Shenzhen, they are talking only about 50 yuan per person. And in Hong Kong, you're talking about $5,000 per person. So there is a 100 times difference between the stimulus. So in fact, the Chinese government is not doing enough to stimulate the economy. But the problem is, over the last 3 years, they spent all their money on this net zero policy, and they don't have, the local governments don't have too much money left. They are running huge deficits, and the central governments need to bail out the local governments. So that is why the economic stimulus, the economic growth, is still leaves something to be desired.
Marc, if you take all this data that we've seen this week, what does it mean for Chinese assets, particularly for the yuan and also for Chinese equities?
I think Francis makes a very, very good point that the amount of policy support and stimulus that's been announced so far is still inadequate if you are to get back to a pace of growth which results in an expansion of both the demand side and the supply side. So we need to see more stimulus, particularly around discretionary consumption. So there is talk of some supports for the auto sector where you're seeing a big price war going on because of excess supply and inventory. So what does it mean? I think that we need to wait and see what policy developments are there. But Francis also makes another good point, which is that actually at a local government level, the fiscal position is very, very stretched. And the central government thus far has not indicated its willingness to backstop provincial governments that come into trouble. And of course, the very much preferred measure of initial stimulus during previous rounds has been local governments dispersing funds to get infrastructure projects started. And we've seen quite a lot of that already in the loan growth stats that we've seen year to date. But there's a limit to that because of the fiscal difficulties that local governments are currently facing.
Francis, what did you see this all meaning for Chinese stocks, for the yuan?
Not very good. Ever since 2015, the Shanghai Composite Index has hovered around the 3,000 level, and it has zero chance of reaching 5,000 in the next year. So this means the Chinese economy, they invested money into too much infrastructure, because every time they talk about infrastructure building, but the fact is, China's pride, the high-speed railway, only several lines are making money. Most high-speed railway lines are not making money. Some of them are making huge losses. They become a drag on the economy. The money is not being invested where they need to be, like in consumption, things like that. So you look at the big figures, it looks good, but if you look at the small figures, it's not very good. So the Chinese economy will continue to lag behind, and the Chinese stock market will continue to trade around 3,000 level.
Marc, we're seeing capital outflows from Hong Kong, aren't we? The aggregate balance now down below 50 billion Hong Kong dollars. I think that's the lowest in about 15 years, and that's obviously weakening the Hong Kong dollar. What is the significance of this? Why are we seeing these outflows, first of all?
I think on a backward-looking basis, there's clearly been quite a powerful net migration outwards wave in Hong Kong, particularly driven by the COVID pandemic and the restrictions that were in place there. Another factor as well has been similar to the mainland, but for somewhat different reasons, is the very stretched fiscal position of the Hong Kong government. We've had big budget deficits the last couple of years. The hope is that with the very restrictive COVID measures behind us, and with some signs of life in the Hong Kong economy again, the fiscal position will improve, particularly in terms of tax revenues, with some additional support for local businesses as well. So it's partly driven by migration and people taking their savings with them, but also perhaps some concerns over the sustainability of current spending. But on a look-forward basis, there are some tentative signs of better times to come, I would say.
And we've got this big difference, haven't we, between LIBOR and HIBOR. HIBOR's at about 3.5%, LIBOR about 5.25%. Presumably, the sort of the balancing of the exchange rate mechanism will sort that out eventually, because local banks, they're going to have to raise their interest rates, aren't they?
Yeah, definitely. When you 2% interest rate difference on the link fixing exchange rate, you're going to have pressure on the Hong Kong dollar. So the monetary authority will have to defend the Hong Kong dollar, come what may. But as long as there's an interest rate disparity, the pressure will be maintained. So I think we have to live with it for a certain period.
Marc, final word to you. Do you see this being sorted out by local banks raising their interest rates? They're going to have to raise the prime rate, aren't they? Because liquidity is just draining out of the system.
Yeah, it's a very different situation to the US, where actually banks have been sitting on excess deposits for some time, partly for regulatory capital reasons, but also because of a pretty muted recovery. So loan deposit ratios in the large US banks are somewhere around the 40s to 50s mark. So they don't have to chase deposits to buy offering higher deposit rates. Hong Kong's different. The loan to deposit ratios are much higher, partly because the loan books have been much more skewed by the real estate sector historically. So indeed, either deposits have to reprice, or the Hong Kong system has to hope that we're close to the end of the rate hike cycle, and at some point we'll see some rate cuts.
Okay, well, thank you both very much for your thoughts this morning. It's always great to speak to you. You heard there Marc Franklin, who is Managing Director and Senior Portfolio Manager of Multi-Asset Solutions at Manulife Investment Management here in Hong Kong, and also Francis Lun, who is the CEO of GEO Securities. I'm joined now by Toby Lawson, who is Director at Statton Advice down in Sydney, Australia. Morning, Toby.
Yeah, good morning, Peter.
Let me ask you first about this key Janet Yellen speech that she made yesterday on US economic relations with China. Did you get the sense from that she's trying to put things back on track, and is she going to succeed?
Yeah, it was an interesting one. National security trumping economic interest. Not sure how that plays out. I think there's a combination there, but I think the three elements of, not being afraid to raise concerns about, predatory tactics in the trade sector or what have you is one thing in relation to China. I think a little bit of an olive branch around seeking healthy and fair economic competition. And also, I think the easy one in terms of engaging on health and climate change from a global perspective, sort of temper a little bit of the more assertive language around national security.
And there was this sting in the tail, wasn't there, about more restrictions on outbound investment into sensitive sectors like technology that maybe have national security implications. So it seems to be, on the one hand, she's saying I want a normal economic relationship with China, but at the same time be prepared and ready for more restrictions.
Yeah, I think this is the line in the sand, and I think it'll be interesting to see how Beijing responds, or at least how mainland China responds to this, whether they see it as a balanced view or as aggressive posturing by the United States. That'll be interesting to see, because that will probably be more interesting than what Yellen said is how China reacts.
And what's interesting is that the approach of the US seems to be, she talks about pushing its friends to join in either with sanctions or to have this so-called friend-shoring initiative with countries that include places like India, Indonesia, Vietnam. She said she's considering a trip to Vietnam. She really wants to try and diversify, doesn't she, into some of these emerging market nations.
Well, I think that's the obvious trend that's occurred even, since the pandemic, I guess, which sort of highlighted a lot of direct exposure into China for a lot of US corporates and the US interests. and diversifying that in is the largest growing populous region of the world makes total sense for the United States and probably for Europe and others. So yeah, friendshoring, I think, is that the expression? I haven't heard of it, but that makes sense. And it's really just a strategic balancing, to ensure that there's a hedge against China.
And one of those countries she mentioned, India, the country you used to live in until recently. There seems to be quite a lot going on there at the moment. First of all, Apple has just opened its first 2 stores in India, one in Mumbai and one in Delhi. Tim Cook was over there to inaugurate those stores. How important is this in terms of, I suppose, first of all, the symbolism, isn't it, of Apple opening its first 2 stores in India? It seems to suggest quite a big commitment to the country.
I think the optics are really important, and I think Tim Cook in Delhi managed to meet Prime Minister Modi, so that tells you something about the level of importance of this particular relationship. But it's important to note that Apple have invested in India for the last 6 years, and most recently have really up their level of investment in the manufacturing capability. So I think about a month ago, I think there was an announcement that Foxconn, which obviously is the Taiwanese company that produces a lot of the component parts for Apple, was investing $700 million in a manufacturing capacity in Karnataka, which is a state in India, and that would lead to the amount of manufacturing coming from India for Apple was about 5 or 6% now, would go towards 25% in the coming years. So it is quite significant that Apple investing in India much more aggressive. They already have been, so it's not new. But I think this is symbolic, with the retail stores, noting, of course, that Apple is a premium product in India versus the Android product, which is much cheaper. 95% of mobile users, I think, are on Android. So it's going to be a premium market to try to tap the rising middle class in India. But most recently this week, it's quite an important symbolic investment by a large US company.
And if I look at some of the figures, Apple currently now manufactures 5 to 7% of its iPhones in India. It doesn't seem a lot, but then when you compare it to just 2021, when they made just 1%, it's quite a big jump, isn't it? So do you think Apple sees India as the new China?
I think it's quite a broad statement to say new China. I think it's definitely, I think for Foxconn and Apple, same as what you mentioned in our previous conversation around US interests being diversified, to not be purely reliant upon Chinese manufacturing. I think this is the same scenario playing out for large corporates, is to hedge, diversify their capacity across the region as opposed to in one particular country. And India, I think, will become, maybe a quarter of Apple's production in the coming years.
As much as that. That's the government target, I think, isn't it? I think it hopes
that's
Apple...
That's the government target, so they'll get some incentives to move it in there. And this plays very much to Modi's Make in India push. That and this will be, if you want to be successful in India, in terms of an outsider coming in, it's really about you need to produce onshore.
But I suppose the reality is, even though Apple is going to start making products in countries like India, it's also making MacBooks, I think, in Vietnam, it's not going to completely disengage from China, is it? It's still going to be manufacturing a significant amount there. And anyway, these supply chains are very deeply embedded into the Chinese economy.
Yeah, I don't think as I said, I don't think it's a replacement strategy. It's a diversification strategy. And any good investor will tell, well, anyone who advises you who wants to be a good investor, is diversification is key to reduce risk. And it makes sense. You would do it if you're an investor. You would want to make sure that you're slightly diversified to any risk against a single asset. This is the same thing in much big geopolitical terms, I guess, but it's the same concept.
Now, the other piece of news we had out of India, which is significant, is that India's on its way to becoming the world's most populous nation. It's going to overtake China sometime this summer. It will have about 30 million more people. That's according to data from the United Nations. They say India's population is going to be estimated at 1.4286 billion against 1.4257 billion for China. But the key thing is these two nations, India and China, are now going to be more than a third of the total global population of just over 8 billion. But it does seem significant, doesn't it? Because this is a very big demographic change that's going on in India.
It's a big shift. I did hear the other day, and again, I may be slightly wrong in the numbers here, but in whether it's the next 20 years or so, India will be 1.6 billion, whereas China will drop towards 1 billion.
That's what I heard as well. It's going to keep growing for the next 4 decades, I think, and peak at about 1.7 billion.
That's it, yeah. So India will become the most populous by a fair margin. Having lived in India, and I always marvel when people complain about traffic in Sydney. I lived in a city of Mumbai that is the equivalent of the whole population of Australia. So this idea of relativity, people who haven't lived in India or been in India don't realise the sheer scale of India in terms of the population. The difficulty thing for India, I think, is creating enough jobs that will lift those who are extremely poor, and there's a large percentage in India, into wealth creative jobs. And that, to me, I think is going to be the great challenge. The population growth is one thing, but being able to provide them with opportunity is going to be the greatest challenge for the governments going forward in India, because they're a slightly a rising middle class, but they also still have a very, very large poor element of the economy, and the challenge will be to lift them out of poverty, to give them jobs that can create wealth, and this will be one of the great challenges over the next decade or two in India.
And how does the government propose to do that?
Well, this is all about building the Make in India, not purely, but one of the strategies is obviously to promote manufacturing onshore, industries onshore. It's not to replicate the heavy manufacturing that China, but it's be impossible to replicate that, particularly as we're into a new economy, digital, what have you. So, you've already seen the success of offshoring and outsourcing type businesses in India. The benefit being that the well-educated, computer-literate, English-speaking tends to be something that gives them an opportunity to really go well in that particular sector. I think, obviously, in agriculture, creating efficiencies around that, energy in renewables. So really trying to establish new industries, light manufacturing, digital economy. The difficulty in that is that it tends to be less labour-intensive, some of these industries. So this will be the challenge, is to obviously invest in the right industries that can create enough jobs at the same time as managing what is going to be a digital world rather than a heavy manufacturing world.
I suppose one advantage that India does have with this demographic change is that its population is quite young, isn't it? Whereas if you compare that with China, China's population is getting old. There's more and more pensioners and retired people that are having to be supported by less and less working people, whereas it seems to be the opposite in India. You have this huge young group of people who are all employable and skilled.
Yeah, so there's pluses and minuses to that, right? So your dependency ratio is what you're talking about, very much in favour of India in terms of demographics. They have a young population. But again, the downside of that is that they're all aspirational and they want all good jobs. And, are there enough good jobs for that rising level of workforce? The flip side is that, of course, China had its one child policy for many years and worked very effectively for them in terms of population control. But now they have an aging population. And worse for them is that those that came through that one child policy are having less children themselves. So as we mentioned earlier, that their population rate will decline, such that in that period going forward, their population could drop towards 1 billion from 1.4, and whereas India goes the other way. So there's pluses and minuses to both those stories, right? And India has a huge value proposition because it has a younger population, but they need the jobs and they need the industries to be able to support them.
Toby, it's always a pleasure talking to you. Have a great weekend. That's Toby Lawson, who is Director at Statton Advice. And thank you very much for listening this week. You can get more information on breaking business news and market movements in my daily updates, which are posted on peterlewismoneytalk.substack.com. On Monday's programme, I'll be joined by Alex Wong, Director at Alex KY Wong Asset Management, and Dickie Wong, Head of Research at Kingston Securities, with a view for mainland China, is Shanghai-based independent economist Andy Scher. Have a great weekend, and I'll see you on Monday.
Money Talk